Weekly stock market update. Are you ready for it? Of course you are. Don't forget to have a look at the campaign for $1million.com to teach 1 million people how to be better investors. This is for educational information purposes. It is not individual financial advice, and the markets can fall and capital is at risk always in investing. These are your valuations. You're paying $26 for $1 of future profits in Microsoft. Okay, and you can see most things are expensive. They've been like this for a few years now. The cheaper ones have not been the biggest movers up, although energy and a few in telecom services and in banks continue to look attractive, and we'll go into some of those individual stocks in a moment. Anything coming up on the earnings which could move markets? I guess Oracle has quite a bit of room to move the markets. Adobe, if you're somebody who's holding it, then that's an important one. At the moment, the markets are really punishing people, even if they exceed expectations, but they don't exceed them by a big enough margin. They're hitting them with a 10% drop. So don't be surprised if otherwise good companies drop to 10%. Then, of course, what you see is them rebounding a few weeks, months later. But it's more volatile because we've had such a big rise. There's a whole bunch of people who are profit takers. You don't get them at the bottom of a bear market. You get them at the top of a bull market. You've got even more sellers. Okay, don't forget to do all of that. Now, as you know, my approach is data driven, and it's incredibly diligent for both my pension and my son's and wife's pension. If you want to know more, like I said, have a look at campaignfor1million.com. I need to tick the valuation, the growth, the income box. This is the most important thing. Now, I created a proprietary algorithm over the last 20 years, been using it. It's published in my Financial Times published books and in my Macmillan books. There you go. And I've written about it all at length, based on Nobel Prize winning research from Daniel Kahneman, Eugene Famer, and Richard Thaler, amongst others. Okay. And it scores stocks, but that's not the only thing. That's not good enough. It weighs valuation more than growth, more than income, but that in itself won't be good enough. We also want Croaky from Goldman Sachs Wealth Management. We want momentum. We want high sortinos and alphas. That means we want companies which generate high reward on average, but consistently. In other words, the risk or volatility to the downside is very limited. And when the markets give a tailwind, they fly more. And if the markets have a headwind, they don't fall as far. So they're resilient by their nature. Now, we want to tick all those boxes because it's our bloody pensions after all. So how has the past week been? Not much green, not been a good week, but then we know that for September anyway, that September tends not to be particularly good, and we're not going to go chase momentum. Funny how people don't talk about sector rotation anymore, do they? Okay, what about the past year? Well, the past year shows what we're really all about. What we're trying to do is make sure that we've got the knowledge and the data to take advantage of market tailwinds. I don't know if there's going to be a tailwind or a headwind. I can make educated guesses, but I don't like investing on guesses. What I like to do is be in a position to take advantage of opportunities based on companies which value growth income. Now, you might have said, well, actually, Alpesh, you didn't need to do any of that. You could have just thrown darts at a dartboard and you would have done well over the past year. You're right. However, I'd rather have done it more data-driven, which is what we did. And we got some good ones. But also, I'm afraid we got some ones which didn't do as well. Well, wait a minute, Alpesh, how can you have the same process which leads to 22% on one and only 120 on the other? And surely if you're that good, you should have just picked NVIDIA and nothing else. We don't have a timetable. We're not in the stock gambling business. And that's why we have more than one stock, just like Warren Buffett has more than one stock. Okay, so there are these other ones. We'd love for them all to be up, but it just doesn't work out always like that, unfortunately. How about exchange traded funds? Well, over the past month, lots of green there. I will talk to you separately about those on a separate video. Year-to-date markets, well, if you're up 15% on your pension, you might be a bit disappointed because you could have been up a lot more earlier. Or you might be very happy. But look at how that's made. In the year to date, your pension is made up. So you started in January. Well, if you actually started in February, just 1 month later, you've got a 0% return from February to August. There's nothing to complain about. It's just to say that if you look at the NASDAQ, you got a 0% return for that period. You've also, on the S&P, got a 0% return for prolonged periods of time. Okay? You get very lengthy periods of time where you get no returns, and yet you get 15% overall. So be aware of that in your pension. It stops you exiting at the top, and then, well, sorry, it stops you exiting at the bottom and getting in at the top, because you get more perspective. So most of the time you're sitting on your hands doing nothing. but you also need to know when you shouldn't be doing that. And this is the same with individual stocks as well, which people often don't realize. Now, these are the various sectors which have been doing well. One thing you need to know is I don't gamble on sectors. I don't start as a horse race in January thinking, oh, this horse is going to win, this one's going to lose. It's a mess. And look at the volatility. So I show you this to show you how much these move, but also the volatility. And we actually don't look at individual sectors, we look at stocks. Okay, when we're looking at factors, we don't gamble on, is it momentum, value, growth, what is it? Because look at that, again, the variances can be quite shocking. What we do is we say it has to be ticking the value box, and a subset of that is the value growth companies, and a subset of that is the value growth momentum companies. In other words, I need them ticking all of these boxes so that the only ones we're left with will be a subset which gives us the returns. Okay, over the past year, if over the past year your pension is up 21% or more, well done. But look at what it went through if it just even tracked an index. And there's nothing wrong with tracking an index. Loss, gain, 0%. 0% again. Okay, 0%. 0%. Prolonged periods of gains and then losing all those gains. Gains, then losing all those gains. Gains, then losing the gains. The reason I mention this is 22% in a year is composed of 3 times out of 4 either losses, losing gains, or 0%. So in other words, 3 times out of 4, nothing good. Only once out of 4 is it going up, which is one of the reasons people say don't try and time. But we look at 12 months, not 1 month or 1 week or so on for that reason. So what are the FTSE 350 biggest rises over the past month? They happen to be these, just out of interest, just letting you know. Let's turn to the S&P. It's still on an upward rip, but it is overbought. So it's the kind of market where I don't want to be buying more of anything. If anything, something I particularly happen to like, I'd probably toe dip in. Consumer cyclicals, healthcare, United Health at the moment. I'll look at others in a second. But I certainly wouldn't be gung-ho because it's overbought and it might do what it did here, which has become a daddy bear and fall. So that's the period where in our pension we were holding cash because we avoided this massive fall. So by holding cash, i.e. not looking for other securities, holding cash, we avoided those falls, had the peace of mind, and then when this stopped falling and we could get back in, that big gain, which in some stocks was 100% return, we managed to capture quite a bit of and avoid the falls. So we didn't do the snakes and ladders and a 0% over 2 years. We managed just to do more of the ladder. Now, once every 7 years, that becomes a necessity. Might be about to happen. We don't know at the moment. I'm just cautiously optimistic. NASDAQ, similar kind of story. Be warned, it's making a higher low. When that happens, it suggests that we could go low. We could easily go back to these levels this month alone. Now, at the moment, this is rising, so I'm not going to buy more NASDAQ index at this level at all. I continuously monitor what I'm holding. I don't panic. I won't panic unless, well, I won't panic at all, but unless that crosses below there. Okay, FTSE 100. Rising in that direction. Top 10 S&P 500 stocks over the past month are these. Let's have a look at some of these to make sure we're not missing anything. Well, Fortinet's been in the portfolio and one of the ones there for a while, but the others haven't. So let's make sure we're not missing anything. So Fortinet, and this is what I mean. Look at that, 18% down. For months you're looking at this thinking, oh, I've got bloody nothing from start of the year until August. Then all of a sudden, massive jump up. That's sadly how prices sometimes move. Value, growth, income we can look at, but they don't always go like this did in that smooth line. And you had people who might have got in and thought, oh my God, nothing's happening, I want to get out. It is a 7. Would I buy more? No. Well, no, because of what I've told you at the moment. I'm just a bit concerned at the moment with the market. You could toe dip in, but it is higher risk because it can drop 18% in no time. And thankfully that is more positive and that's the direction. So there are a lot of positives for it, but this is higher risk given the background I've given you. What about Southwest? Well, I wouldn't because it's not 7, 8, or 9. All the momentum looks good. Not one for me, but some of you might like it. Up to you. Axon, good upward, but 21% drops. Overbought, not for me, thank you. Starbucks, that new CEO, high risk because of that. September's not particularly good. Some people saying sell. Downward trend, not broken. Not for me, thank you. Best Buy, not a 7, 8, or 9. Though that acceleration is promising. It is promising. However, it's not 7, 8, or 9, so not one for me, I'm afraid. CanView is a 7, but we don't have enough data on the MACD and momentum, and it's below $50, which really puts it in the penny share market. So if you're really into your high risk, that's up to you. Not one for me. Not enough data there either. Uber, now we did well out of Uber back in 2022. 2020, when it was one of the ones which sort of jumped ahead significantly. But now it's overbought, so not for me, and it's not 7, 8, or 9. So I don't care that it's had this bit of a dead cat bounce. Also, what it teaches is when to stay clear. That's an 8, but it looks a little bit lackluster. Could well do this. I mean, it could well go from 135 to 200, but not me at the moment. Similar with General Motors, not me at the moment. Costco, it is one we'll return to in the future, because we know it can give us these kinds of returns periodically. It's just that right now, being overbought, it's not possibly likely to. It's a bit cautious entry. You'd really be defying too many of my red flags to get in. I'm not saying it's going to fall. What I'm saying, and I'm saying it may well rise, but there's alternatives for me, as Warren Buffett would say. Where else could you put your money? I continue holding Apple, Amazon, as you know. I know these are falling, but then again, I've got gains to buffer or to cushion my falls since January 2023, so it's not really a problem for me. That's about to become a daddy bear. Until it does, we don't go into cash, but some of you may well go early into cash, and it might do that. It might not. It might just do that and just squiggle along. But it is worrying. Worrying in the sense that we're going to take some profits now from January 2023. In a SIP, those profits are not taxed, so it's fine. Meta, overbought, so I wouldn't buy more at the moment. It just needs to let off some steam, which means that drops there a bit more, that drops down. Once it gets to these levels, we're back in and we ride it up. We're not timing, because that happens so infrequently, you couldn't really call it timing. I don't have Bank of America, but it's been doing rather well and should continue in that direction as well. Netflix 7, as you know, some of you have been saying, you missed it. I've been covering it since it did that big jump after results, just to show how it can drop 20%. But if the MACD is rising, so I wanted to show the power of this. And indeed, it did far better than I even thought it would. It is a bit overbought. It's a bit like it was here, so just be careful, because it is capable of doing that. And you don't want one of these where you think you're all clever and it keeps going up and then it goes back down. I'm not saying it's going to do that. No reason to think it's about to, but that's why we have this rule when it's overbought and it drops sharply. Or the rule of if it drops X, sell Y. And similarly with this, if it drops X, sell Y may well be a good rule for you. Walmart, phenomenal, continuing to rise up. I've been telling people on my Great Investments program that one of the things is that there are some stocks which, when they break above their MACD high with an angle of a steep gradient and the price is rocketing ahead, they can sometimes just accelerate. That happens about only 20% of the time, so be careful. It's overbought at the moment, so it's not for me. But if you're a higher risk taker and you see that 8 and you think, oh, well, actually, yeah, I'll push this, then be my guest. I know consumer cyclicals are doing well at the moment, but as I say, I'm not as risk loving as some might be on that one. Berkshire Hathaway, what do you think about Berkshire Hathaway and Warren Buffett in the 90s forming $1 trillion company? Pretty impressive. Overbought, not for me at the moment. But again, like I said, that rule could apply, that maybe this is just going to be the next Nvidia. And people say, listen, let's give our money to him. Eli Lilly, overbought a bit again. We will come back to it in the future and get those gains again, which is why I say to people, when you're on the program, you're looking at a lifetime. We will come back to it. It's just that I don't necessarily want to get into it right now, given that it's overbought, although I'm mindful of that. I'm mindful those numbers all look rather good. Okay. And you might say, no, forget you, Alpesh. I do want to get in because I think it could do that. Yeah. I mean, it's not a bad one. I wouldn't exactly criticize you for being in. Walt Disney was a disappointment. It's fallen off and just shows you what can happen. So it's a case of wait and see. Lots of buys. September doesn't tend to be good. CVS also multi-year lows. We know it's the kind of company which can go from 58 to 100 because it's done it before. But it is a case of wait and watch. Unfortunately, block all these. I won't go into right now. Well, let's get Charles River. Again, another one which... now, what happens if you get stocks like this and you think, oh, actually, I wish I hadn't in future? Well, in future, what you do is you just look at those drawdowns and you say, well, I don't want the stock like this because it's got too steep a drawdown. Okay, September doesn't tend to be too strong either. Should hold on to that support and probably go as low as that even. And you're just waiting around for it to then rebound up if you were in it, but it wouldn't buy more now. Similarly with this, some of these have gone on to multi-year where you think they're going to continue upwards and they drop back. So it just shows you how markets can fall, and that's moved below its own moving average. So if you were looking for a reason to exit, you'd have it there. If you're more risk loving, you might wait. Anything below 100 should be treated as a penny stock anyway, and that can be a useful lesson in the future, which is actually if it's below 100, don't have it if you don't like risk. This looks like it's going to move low, so you would exit this if you haven't already done so anyway when it came off its high. So if you haven't already exit. That's a waiting game, isn't it? Have a look at my LinkedIn as well, and have a look at the campaign for $1million.com and the links in the bio to see how we're trying to add more of those great companies into pensions to get pensions to move up. But actually, really what we're doing is two things: giving people the data and the knowledge to use that data. Data and the knowledge allows you to manage your own portfolio. Particularly attractive if you run your own business, you're an entrepreneur, you're sick of wealth managers, fund managers, and also if you're close to a retirement or in retirement and got fed up with the wealth manager or want to have a more hands-on approach and want that knowledge to get the growth. At least you'll have the transparency of the data and the know-how. Always have the data and the know-how. Have that communication with me so that you're in a better position to control it, because leaving it to other people, it's just too risky. Anything in life, leaving to just other people. It really needs you to be in charge of it. Okay, so have a look at campaignfor1million.com. Thank you all very much.